Over the past 100 years, the annual real return on the S&P 500, the 500 largest US companies, was around 7%. By comparison, treasury bills, which are virtually risk-free, returned less than 1% a year. This difference is referred to as the equity premium puzzle. Now, some of you are probably thinking, Joe mate, I've solved the puzzle. Stocks are way riskier than short-term US government debt, so of course they return more. Higher risk equals higher reward. Everyone knows that. And yes, that's true, but investors would have to be incredibly risk-averse for this to make sense. Imagine I proposed a bet where I flip a coin, and if it's heads, I give you $100, but if it's tails, I give you $50. How much money would you accept from me in order to not take the bet? A rational person might say, well, I've got a 50% probability of either getting $100 or $50, so my expected payoff is $75. Maybe I'll ask for $70 just to be safe. Okay, great. Sounds fair. Well, in order to explain the equity premium puzzle, the average amount an investor would accept in order to avoid the bet would be $51, only marginally more than the lowest possible payoff of $50. This is crazy. How can investors be so risk-averse? Clearly, risk aversion alone is not the answer. So why do stocks return so much more than bonds? Hi guys, Joe here from Money Talks, and today we're going to explain the equity premium puzzle. In order to try to explain the equity premium puzzle, we're going to use two elements of human psychology that probably influence every aspect of your life without you even knowing it: loss aversion and mental accounting. Let's start with loss aversion. This simply means that we feel losses more strongly than gains. Suppose I offer to flip a coin. If it's heads, I pay you $150, but if it's tails, you pay me $100. Would you take the bet? Pause the video and comment down below. A purely rational person would say yes, since their expected payoff is 50% times 150 minus 50% times 100, so 25. However, prospect theory says that you wouldn't. Research shows that we feel losses twice as strongly as gains. Put into context, this means the average investor would only invest in a stock if they thought it could return at least twice as much as the possible downside. If investors are highly loss-averse, they will demand a greater premium for risky investments, and so prospect theory can help explain some of the equity premium puzzle. On its own, however, loss aversion is not enough to fully explain why stocks outperform bonds by such a large margin, and so we need to employ one more concept: mental accounting. Ignoring transaction costs, a purely rational person would say that a dollar is a dollar, no matter where it comes from. However, most normal people wouldn't, say, remortgage their house in order to buy groceries, and instead would choose to use cash in their current account or maybe a credit card. While this example may seem unrealistic, lots of people are unwilling to spend money from a savings account. What this shows is that the average person values money differently depending on which mental account it is in, and these mental accounts can have different purposes and properties. Take the bet I mentioned before, where you have a 50% chance of either winning $150 or losing $100. If I offered to run this bet an infinite number of times, would you accept? Most people would now say yes, since the more the bet is played, the higher the chance you win overall. If you said no the first time and yes to this, congratulations, you're irrational. If you separate each bet into its own mental account and evaluate them individually, it seems like a series of risky bets that you may be unwilling to take. If you aggregate them, however, and evaluate them as one, it's practically a guaranteed win. To explain how this relates to investing, suppose there are two investors that both buy the same stock and hold it for 1 year. The first investor looks at her portfolio every day, while the second investor looks at his in a year's time. The first investor will perceive the stock to be far riskier than the second investor, as they see each day as a separate mental account. This means they will demand a higher premium for holding the risky asset. This is the rationale behind Warren Buffett's advice to buy the S&P 500 index tracker and never look at it again. Combine this with the previous concept and you get myopic loss aversion. This simple theory can single-handedly explain why stocks have outperformed bonds by so much. And while it's impossible to say for sure, research has shown that professional traders actually exhibit myopic loss aversion to a greater extent than the average individual, suggesting myopic loss aversion may in fact be the solution to the equity premium puzzle. That's all for this video. If you enjoyed it, feel free to leave a like and subscribe to see more like it. Thanks for watching Money Talks, and as always, have a great day.